Welcome to the Capital News. I am your host, Alex Crisis. Today is May 21st, 2019. Thank you for joining me. So the title of today's podcast is Not a Subprime Crisis This Time, and we'll get into what that means here shortly. But the S&P closed up 24 points. The Dow gained 197 points. The NASDAQ was up 83 points, representing a 1% gain. And the Russell 2000, the small cap index, gained 20, representing a 1.3% gain for the day. I will explain what happened on Wall Street. Oil, WTI, is down a little bit at $62.68. Brent now sits at $71.87 a barrel. Both are down about a half a percentage point. Gold is at $1,273 an ounce. Silver was at $14.42 an ounce. Again, if you stack the stuff, if you're a precious metals investor or somebody who just wants to be diversified, buy low, sell high. These prices are down. Silver is below its break-even cost for mining. So take a look at it. 10-year U.S. Treasury sold off a little bit, so the yield increased again for the second day in a row. We now sit at 2.426% on the 10-year U.S. Treasury. And the VIX, the volatility index, lost 8 percentage points and now sits at 1495. So why the reversal from yesterday's, I don't want to call it a big sell-off, but I mean, obviously the NASDAQ lost 1.5 percentage points yesterday, and it regained 1 percent point back today. Well, what drove it down yesterday, a reversal, is what caused the reversal in the short rally that we saw today. And I am talking about Huawei, the Chinese tech firm. Because yesterday we had the U.S. government, i.e. President Donald Trump's strongman, tariff man extraordinaire, playing the strongman, saying, you know what, we're going to have some issues here with Huawei, and we are just going to restrict them. We are not going to allow them in the United States. We are not going to allow U.S. companies to do business with Huawei. Whole host of issues. Now, today is another day, and of course, the president's precious stock market sold off yesterday, and we can't have any of those shenanigans, again, because he is manipulating these markets, because he has foolishly taken ownership of the stock market and the economy, and he doesn't want to see it go down because he doesn't want to be blamed for it. So now the United States government comes out and says, well, we're going to be a little softer on Huawei. We really didn't mean it. We just kind of wanted to see what happened in the stock market. We're just playing with it because it's our own personal piggy bank here. So the markets liked it, and they rallied. So what let us down yesterday was tech. What let us up today was tech because of headlines, again, because of tweets, because of statements from the government. This is not a free market capitalistic system. It's just not. When you have people at the White House coming out and making statements and the markets move like this, and this is global. This isn't just the United States. This was the Asian markets. This was the European markets. Everything that we went. We went all around the world yesterday talking about the global equity markets, what took place because of the news regarding Huawei. And everything was down. Now, pretty much the complete reversal because we're not going to be that tough. I didn't mean it. I didn't realize the stock market would sell off that significantly. So, I can't have any of that. So we're going to reverse it. And this is just kicking the can down the road. This is just a temporary breather until, I believe, August. But, I mean, what difference does it make? Because that headline could change again tomorrow. There's no credibility. There's no consistency except the inconsistency and the chaos that is ensuing in this complete and utter manipulation and abuse of power by this administration to manipulate these markets. You think they don't know these types of headlines move markets up and down? I do. And I think that's a problem. I think that's an abuse of power. Now, there's a lot to get to today. There were some things that we discussed yesterday in regards to Federal Reserve Chairman Jerome Powell giving a speech yesterday. We touched on that slightly. We're going to have a little bit of a further discussion on that today. We were also discussing the Reserve Bank of Australia and how they were throwing some language out there where we are now anticipating a rate cut, not wait and see, not a rate hike, but a rate cut. And now it looks like it's going to happen perhaps as early as next month. The markets were anticipating the cut to take place later in the year, perhaps September. Now that looks like it's been pulled forward, and it might actually take place next month. Again, that's going to be on the back of some other data that the Reserve Bank of Australia is looking at. Primarily, they are concerned with unemployment. So if the unemployment rate ticks up, which it most recently did, then, well, they might just be inclined to actually cut interest rates to a new all-time record low. It has been at an all-time record low, and of course I'm talking about the interest rate in Australia for the past, I believe, 33 months. So it looks like it might go down, and right now it's at 1.5%. Anticipation would be for 1.25% if they happen to cut, and we're going to go through some of those headlines too. So Huawei was for the major reversal that we saw in global equities. The title of today's episode, Not a Subprime Crisis, this time has to deal with Jerome Powell's comments, which we will get to here shortly. But there was a handful of headlines that I want to go through here today. I may have the opportunity to speak in depth on a couple of them, but others we're just going to sort of gloss over. We're not going to be surprised by most of them. This is in anticipation. So let me just read some of these off to you. Australian Central Bank to consider rate cut at June meeting. That's what we just got over with, okay? Singapore cuts 2019 GDP forecast as Q1 growth hits a decade low. So that's not good. Bank of Japan's Kuroda, he is the chairman of the BOJ, issues fresh warning of broad fallout from trade war. So the Japanese love to print money. They love low interest rates. In fact, they have negative interest rates, which I hope and pray does not come to a theater near you here in the United States, but it very well may. We have the Federal Reserve's Powell. Business debt, no subprime crisis, but still merits reflection. We're going to talk on that here shortly. The Thailand Q1 GDP growth falls to weakest in more than 4 years, with the outlook murky. Not good either. WTO, World Trade Organization, quarterly trade growth indicator remains at a 9-year low. What happened 9-10 years ago? Oh, yeah, that's right, the financial crisis. That ain't a pretty picture either. But we are in the midst of the best economy ever. Pay no attention to that. We have a pool of economists, low rates to underpin, not revive, Canada's housing market. Something we've been discussing here for months, something that is on our list of market risks for 2019 and beyond. We were talking about Australia yesterday, a brief synopsis of how that also correlates with Canada, but now here we are right again with Canada, their housing market. So low rates aren't going to save the day. It's not going to revive it. It's just going to keep it going until what? A collapse. So not pretty. So those are some of the headlines there. A little more in depth when it comes to the Reserve Bank of Australia, because there's some interesting things here. Title, Easing Australia's Mortgage Rules Complementary to a Rate Cut. A proposed easing of lending criteria by Australia's prudential regulator would be, quote, complementary to a rate cut if it takes effect, the country's top central banker said on Tuesday. Earlier in the day, the Australian Prudential Regulation Authority proposed to remove a minimum 7% interest rate banks currently assume when considering loan applications. Quote, it would be complementary to a monetary easing if that takes place, Governor Philip Lowe said. He is the governor of the Reserve Bank of Australia. He continues, quote, I don't think it has direct implications to monetary policy at all. Of course he's going to say that. Continuing with this, Australia Central Bank governor says monetary policy alone cannot drive growth. He is looking for the national government of Australia to also step up. This, to me, folks, is a central banker telegraphing, you have to read between the lines, maybe agreeing with what I've been saying here for months, that my biggest concern, or one of my biggest concerns, is central banks, their bullets, their ammunition, runs out of lead. They got bullets, but they're not effective. This is diminishing marginal returns kicking in. It's not going to make it. We can cut interest rates. We can maybe do some quantitative easing, but it's not going to be enough. The federal government's going to have to step up. Again, this is on the Australian side of things. You got to pay attention to what these people say, because we don't live in a free market capitalistic system. We live in an economy, in a political system that is run by prime ministers, by presidents taking to Twitter, and by central bankers making statements. So we have to pay attention. Now, could I be interpreting these comments wrong? Absolutely, I could be. But this is consistent with what I have been saying for months. And now we finally have a central banker coming out and saying, well, monetary policy probably isn't enough. So what is the national government of Australia going to do? Are they going to cut taxes? They're going to deregulate? They're going to loosen the lending regulations? Does that sound like a good idea? Isn't that what we did in the subprime crisis? This is the problem when you have all of this liquidity out there, folks. It has to go somewhere. And so you have central bankers and banks and regulators and governments and politicians coming out and saying, well, maybe we have to be a little bit lax. We got to lax our standards here. We got to relax everything. We got to say, well, typically we wouldn't give you this loan because maybe you don't make that much money. Maybe you're a poor credit risk. Maybe you already have enough debt as it is. But hey, you want a house, we'll give it to you. That is extremely reminiscent of the lead up to the subprime crisis, 04, 05, 06, and then the subsequent collapse in 07, 08, and 09, and thereafter. This is what happens. This is a direct consequence of flawed economic monetary policy, which we talk about here all the time. This is highly predictable. That's why this is no surprise to me when you finally have somebody come out and make these statements. Now, he didn't come out and say that explicitly. You got to read between the lines. It's not enough. Diminishing marginal returns are kicking in. I think they've already kicked in. Now it's just a question of everybody and their mother's going to know it, and that's really the problem. Once everybody and their mother understands the problem, then it starts to become a cascading effect. But we have some more headlines. We have U.S. existing home sales unexpectedly fall. I love these headlines. Everything is unexpected. Nobody expected this. We expected this. We talk about all of the pieces of this economic puzzle here all the time. It's not painting a rosy picture. U.S. existing home sales unexpectedly fall. No surprise to us. 14 straight months of declines on a year-over-year basis. Let me repeat that. 14 straight months of declines on a year-over-year basis. Does this sound like the strongest economy in U.S. history to you? Doesn't sound like it to me. What else do we have? Some other headlines as we make our way through here. Japan exports fall more than estimated. Exports from Japan shrank 2.4% year over year in April, worse than market expectations of a 1.8% drop, and after a 2.4% fall in March. This was the fifth straight month of yearly fall in overseas sales amid weakening global demand and escalating trade conflict between the U.S. and China. Not surprised. Not surprised. More bad economic news. Australia, remaining on Australia, we have a couple other headlines with them. Australia Q1 construction output falls unexpectedly. Again, unexpectedly. I don't know how this was unexpected. We've been talking about the Australian housing problem and construction sector for quite a while here. So who is surprised by this? People who are just cheerleaders and are hoping that everything is fine. We also have Australia's leading index falls 0.1% month over month in April, continuing its downward trend as well. Although in this headline, they didn't say that was unexpected for some reason. Don't know why. We also have another headline. I'm probably going to have to save this for another day, going into it a little bit more in depth. But we have underemployment for recent college grads at a higher rate than what it was in the early 2000s. Underemployment for recent college grads is at a higher rate than what it was during the early 2000s. What happened during the early 2000s? Yeah, that's right. The dot-com crash, that bubble burst, and we had a recession. But this is the strongest job market in the history of man, if you listen to President Donald J. Trump. It's a bunch of baloney. It's a bunch of malarkey. It just ain't true. And this is, you're talking about kids who are 22 to 27 years old. So you have college grads who are either immediately out of school or who have been out of school for, let's say, 4 or 5, maybe even 6 years if they got out early trying to get ahead of the curve. underemployed. So when you look at the BS number, which is the headline unemployment number, which we are, force-fed every time it comes out by the mainstream media, by the financial mainstream media, and by this White House, particularly if it's a quote-unquote good number, meaning it's going lower, we are told right now, of course, the headline number is 3.6. It's a BS number because it doesn't take into consideration all of your broader information, like underemployment, which is what we talked about during the last unemployment report. Because we said you can't just focus on the headlines, you got to do a deeper dive, which is what we did. Check out that podcast. Something was fishy, didn't make sense. And of course, we did a deeper dive. And of course, we actually looked at the numbers and had a discussion here. And we said, yeah, there are some problems. Just like we did with the 3.2% Q1 of 2019 GDP report. We said, this smells fishy. Something ain't right here. We looked at the numbers. Oh, yep, there's a problem. 3.2% is bogus on the GDP figure. 3.6% is a bogus number when it comes to unemployment, because we said U3, remember that's how the government classifies it, is U3. That's the headline unemployment figure of 3.6. But if you want to look at what the government calculates as its broadest unemployment number, is U6. And U6 is currently at 7.3%. So it is twice as high as the official headline U3 figure. Okay? No surprise that underemployment is so high for these students or recent grads. They're not paying well, but they got student loans. Maybe they're paying rent. Maybe they have a car to get to and from work. They got bills to pay. It's a shame what's going on out there. And we have a government and a president that just continually lies to us. There's no truth. There's no leadership. You have complete control and lunatics on the left, and you got an idiot in the Senate I talked about yesterday on the political podcast, in Mitch McConnell, the Republican leader of the Senate, saying the top priority is to increase the tobacco age. You can't be 18 anymore. You got to be 21. That's the biggest problem we have here in the United States. No leadership and total control. Such a shame, the state of our union. Now, if you want to look at unemployment from an even broader perspective, because the government, if you've been unemployed for longer than a year, you're no longer counted as unemployed. You're not working. You can work. You're of working age. You fit all of the other criteria. You just happen to be unemployed for longer than a year. You are no longer counted as unemployed. The government forgets about you because they don't want their numbers to reflect poorly on their policies, which are a bunch of crap. So if you look at that website that we refer to here occasionally, shadowstats.com, and you look at how the government used to calculate it, had they calculated people and counted people who were unemployed for longer than a year, you're talking about an unemployment rate at 21%. 21%. Even if you were to say, Alex, you know what? Okay, I like that you're telling me about shadowstats.com, all this stuff, it's interesting, blah, blah, blah. But maybe this guy has, he doesn't like the government. Maybe he's got an axe to grind, and so he's inflating his numbers. Okay, fair enough, for argument's sake. Cut it in half. 10%, 11%. Is that acceptable to you in the greatest economy ever, according to our president? No, it's not acceptable. So even for argument's sake, if you were to cut that number in half, it's still pathetic. So I'm going to have to do maybe a deeper dive on that tomorrow, because not only were these kids who just graduated now underemployed, but they have more debt than the students who graduated in the early 2000s, probably by about $1 trillion worth. That tiny number. It's just a tiny number. $1 trillion is nothing. You can sneeze at it. It's no problem at all. Now, the Federal Reserve, Chairman Jerome Powell, why we have today's title, not a subprime crisis this time, because during his statements yesterday, the chairman of the Federal Reserve once again brought up the issue of corporate debt, which again, ladies and gentlemen, has been a topic of discussion here on multiple occasions, and it will continue to be a conversation piece for many, many more podcasts to come. Because while I am not anticipating this is going to be the catalyst that sends us into recession, it will be a major domino that will keep us in recession for a long time, or perhaps even put us into a depression. That's how big this problem is. Now, while Jay Powell is correct in saying this is not a subprime crisis this time, because it's worse. Subprime was a couple $1 trillion. We have corporate debt, leveraged loans, $9 trillion. Now, I'm not saying all of those are going to default. I highly doubt all of those loans and bonds would default. But all you need is a fraction of them. All you need is a fraction of them, and it will outdo the subprime crisis. Boom, like that. That's all it takes. The Federal Reserve knows this. The Federal Reserve should have known back in 05-06 when Ben Bernanke was asked questions about the real estate market. He said, no, there's not a bubble here. Everything's fine. We're regulating this. Other agencies within the government are regulating this. The banks have things under control. Blah, 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 blah. Same thing that Jay Powell and everybody else is telling us now. We have everything under control. This is not a problem. They are never going to come out and tell you the truth. They are never going to say that real estate was in a bubble. They are not going to come and tell you that this corporate debt that we are witnessing, that we are staring straight in the face, is a problem. Well, it requires some reflection, is the wording that Jay Powell used. It requires some reflection. It's not a problem. It's not a subprime crisis. It's somewhat of a concern, but it just requires some more reflection. That's all. Does that sound comforting to you? It doesn't sound comforting to me at all. Those are the words you have to pick up on when these people speak, because they are not going to come and tell you, abandon ship, abandon ship. That's not how they work. They're not going to tell you, we got to get a handle on all of this. We got to come together to solve this problem. That's not how they work. That's not how they operate. They're just going to say, yes, it's something that's, it's on our radar. Nothing to see here. We're just going to reflect on it a little bit. $9 trillion and growing. All of this debt starting to come due this year. And that's the investment grade. A lot of the investment grade is coming due this year. Next year and the years after, it's investment grade, but then you start to see a pickup in the amount of junk bonds that are coming due. And we also know, and this is no surprise given recent history from the Great Recession era, of how the ratings agencies come to quote-unquote save the day and save these companies, and they stamp a lot of this crap triple B, which is just a notch or two above junk. That's all they're doing. They're just appeasing everybody. They're just saying, okay, well, yeah, we like the presentation from the CFO and the CEO saying everything's going to be okay, so we'll stamp it triple B. It's the best we can do. We can't put our credibility on the line and stamp it A, double A, or triple A. I mean, my God, we can't do that again. We did that with all the crap in the subprime mortgage crisis. We can't do that again. We'll lose all credibility. We'll go out of business. But we'll cut you a break. We'll take you for your word that everything's going to be fine and dandy, and we'll stamp it triple B. So how much of the triple B, which is considered investment grade, is junk? Well, depending on who you listen to, there are some studies and analysts out there who are saying as much as 45% of it right now is junk. Now, if you understand how this game is played, there are a lot of funds that exist out there within their rules. They can only own investment grade bonds. So, if Moody's, Standard & Poor's, the rating agencies come out and say, well, you know what, there's been a deterioration in the economy, and we think that there is a lot of companies who are currently rated and stamped at triple B, we got to downgrade them to junk. You know what kind of panic that will cause? I mean, I'm telling you folks, because this is going to be a liquidity crisis. This is why central bankers, despite their rhetoric from last year saying, well, we're going to be wait and see, or we're going to actually start to tighten, now they've all done 180s. 180s. If they were on the path to hike, they were going to say, well, now we're going to do wait and see. If they were in wait and see mode, now they're cutting. These guys are starting to panic because they see the problem staring them straight in the face. What will be the catalyst is a completely different story, completely different question. Again, it could come from anywhere. Could the corporate debt problem that exists, could that be a catalyst? Yes, it could be, but I don't anticipate it being the catalyst that starts a recession. It could be a catalyst that starts an earnings recession on the stock market, because as we're starting to see, we have a whole bunch of layoffs. We were talking about the retail closures again. Yesterday, we were talking about Ford cutting 7,000 jobs globally. We were talking about GM closing plants, cutting thousands of jobs themselves. This is true across the entire global auto industry. So this is no surprise. So you could start to have an earnings recession because you're starting to have this debt come due. And so if you have slowing demand, lower revenues, and higher costs because you have to pay off your debts, well, now your earnings are going to take a hit. So it's going to be very interesting to see what happens. I know we covered a lot here today, but there was a lot to cover. We will continue this conversation throughout this week. Who knows what type of headlines or tweets we will see this evening, early morning, and tomorrow, but we'll do our best to keep you posted. Thank you so much for joining me. Please like, share, subscribe, get the word out, leave your comments. We do love hearing from you. This is the Capital News. I am Alex Karitis. Godspeed.